All right, guys, here's October's market update. We have seen a huge improvement in interest rates, as you know. However, what has happened since the Fed actually cut rates is mortgage rates have gone up a little. And a lot of times, this is a phenomenon that clients don't understand. They think when the Fed cuts rates, well, mortgage rates will get even better. Remember that mortgage rates respond to economic data before the Fed cuts rates, and the economic data leads to the Fed rate cut decision. So in other words, mortgage rates respond leading up to a Fed cut rate decision. The market kind of knows, hey, the Fed is going to cut rates. So mortgage rates got better leading up to the last Fed meeting and the Fed rate cut. However, what matters after that Fed meeting and that Fed rate cut is the subsequent data that comes out after the meeting. That's what's going to impact mortgage rates. So no, when you get a Fed rate cut, that doesn't mean that mortgage rates are going to continue to fall afterwards. Mortgage rates are going to respond to a couple of things relative to a Fed rate cut. One, they'll respond to a larger than expected rate cut. So if the Fed cut by a lot more than what the market expected, then yes, after the cut, you're going to see mortgage rates drop more. But again, the mortgage increase or the mortgage decrease is going to happen before the Fed rate cut in most cases. Number two, if the Fed doesn't cut rates, and it was expected to, then mortgage rates will go up. But mostly, you're going to see mortgage rates respond and react leading up to the Fed rate cut. Then after the Fed rate cut, it's all about the inflation data. So CPI and PCE reports, they come out once a month, and then jobs data. The big one is the NFP report. You're looking at the unemployment rate and new jobs creation. Well, so that kind of data since the last Fed meeting has been unfriendly for mortgage rates, and rates have gone up by about 0.25%. So a lot of consumers are thinking, wait a second, I thought rates should have dropped, and they've actually gotten a little bit worse. So we need to keep an eye on the economic data, not just the Fed rate cut. And again, this economic data will start to shape a picture of whether or not the Fed's going to cut again, by how much. And as we go through these weeks, as these reports come out, we'll see the market on the mortgage rate side adjust preemptively before the next Fed meeting. Then we get to the next Fed meeting and we kind of repeat all this. Does the Fed cut by what we thought they were going to? If they do, rates will have already responded, and they won't respond much after the next Fed meeting. If the Fed cuts by more or less than expected, then mortgage rates will respond to that. But really right now, all focus is on inflation and employment data leading up. Now, in other news, we have seen mortgage applications increase significantly. Obviously, there's been more refinance applications, but also, especially this week, I know for us, anecdotally, we've seen more purchase applications. So I think people are getting a little bit of the message. There's a lot of fence sitters for the next Fed decision, also for the election. But one thing to keep in mind is that you can hedge as a buyer, even if you're refinancing, you can hedge future lower rates. If you really want to buy a house, but you're waiting, you can buy your rate down today. So if you bought your rate down to the low fives, yes, you're going to pay some discount points, but you're going to get in a house sooner. You're going to have tax savings sooner. If you're refinancing or moving to a different house, you're going to get that lower rate and save money sooner. So paying a discount point and getting a lower than market rate, you might even break even or make that money back by saving more by getting a lower rate today. Because guess what? Rates may not drop to 5% until the end of 25 or 2026. We don't know. It's so much time still. We need to see what happens in the economy. That buying a rate down right now sometimes makes a lot of sense. It can get you locked in lower than market. Then you can kind of sit back and go, you know what? I don't care what the market does. I don't think it's going to drop insanely quickly. So if you buy down to the low fives, I think you're ahead of the game. The market probably won't naturally get there for quite some time. Now, disclaimer is anything can change. The markets can go in any direction, and the velocity of that direction can change based on a lot of factors. So just keep in mind there are options. This is what we talk to our clients about. Mortgage planning, coming up with a plan that makes sense. The benefits, the tax benefits of owning a home, the financial benefits of gaining equity, they're so big and valuable when buying a house, especially if you're going from being a renter to a homeowner, that it pays to look at how could I get into a mortgage plan now that makes sense and buy a house, especially when home prices are not expected to go down in any material amount. You want to look at the options to get in today versus sitting on the fence. You lose so much money typically by waiting. So there are strategies out there that I'm happy to talk to you about or your clients about. and we'd love to help. So that's the update for now. Things have gotten better. Mortgage rates are still very attractive, much better than they've been for quite some time. They have gone up after the last Fed meeting, which is converse to what a lot of people think, but it makes sense once you dig into the fundamentals of how mortgage rates work. I know it's a little bass backwards, but it does make sense, and I will keep you posted. We watch these things as they come out, all the inflation reports and the job data. So we'll keep you posted. Hope this was helpful. Thanks for taking the time to watch.